Hello, I want to talk to you today about spreads. In the options world, a spread is any strategy that involves two options. They have different strikes or different expirations or both. In the most common spread, also called a vertical spread, you would have an option above the strike and another one below the strike. One might be long and the other would be short. And the idea here is that the two sides offset one another in terms of cost and also in terms of performance. In a typical spread, if the stock moves in one direction, you'll make money, and if it moves in the other direction, you'll lose money. In some situations, a profit zone and loss zone will both be limited. Besides the vertical spread, you also can have a horizontal spread, also known as a calendar spread. In this type, you have the same strike price but different expiration days. So you might have a long position that expires before a short position, and vice versa. You might have a short position expiring first and a long position later. The third type of spread is a diagonal spread. In this spread, both the strike and the expiration are different, so that you have a one position that is, for example, at 40 and another position at 45 that expires later, or at 35 that expires later, and that's why it's called a diagonal spread. Yet another important distinction among spreads is that they may be bullish or bearish or long or short. In other words, there are a lot of varieties to a spread. In a bullish spread, you will be most likely to make a profit if the underlying security moves up in price. In a bearish spread, it's the opposite. It's structured so that you will make money if and when the stock moves down in price. Spreads are used in many different ways and in combinations of ways too. Some more complex varieties of spreads involve opening two different spreads at the same time. For example, a bullish spread and a bearish spread open together. Or another distinction would be a credit spread in which you receive a net amount of money, or a debit spread in which you pay a net amount of money. So in some strategies, you can combine a credit spread and a debit spread together, and the net may be either a net credit or debit. The purpose of these more complex spreads is to limit the potential loss while also limiting the potential profit. The cost of opening spreads that are this complicated may be quite high, and so it's not always a smart idea to open such a spread until you understand what the costs are going to be. Another form of spread is one that's weighted or ratioed on one side or the other. For example, you might open a spread consisting of two short spreads and one long spread, and the long spread may have a higher or a lower strike, making it diagonal. Or you can have the opposite, which would be two long positions and one short position. There again, this weighted type of spread can rely on the type of strategy you're trying to accomplish by opening it. And another aspect of spreads is that most people begin thinking of spreads as being standalone. In other words, you open the spread whether or not you own the stock. However, it's also possible to cover the short side of a spread by owning stock. For example, you might have a spread in which you have vertically created a long position above a short position, and at the same time you own 100 shares of stock. In this case, you will double up on the value if the stock goes up, because the stock increases in value and the long option also increases in value. At the same time, the short option decreases in value if it's a call, or increases in value if it's a put. And so using calls and puts in various spread configurations also affects the direction that you want the stock to move in. If you have a put spread, you are expecting the stock to go down if it's a bullish position, or the stock to go up if it's bearish. In a call spread, a bullish position would hope that the stock goes up, and a bearish position would be based on the idea that you think the stock is going to go down. So in summary, all you can really say about spreads is that they come in so many different varieties that you can set up any situation you want using spreads. Some can be very high risk, others can be very conservative, all depending on the strike selected, the underlying security, and the time to expiration. And the purpose for spreads varies as well. Some people use spreads to hedge portfolio positions, others use them strictly to speculate, and there's a wide range in between. So spreads are very interesting strategies for options trading, and it all depends on what you're hoping to achieve and how much risk you're willing to take. But spreads are worth looking at because they come in so many different ways, so many different formats that they can meet any needs that you might have.